Introduction. Today, we delve into the groundbreaking development of central bank digital currencies, CBDCs, a concept that has been embraced by various countries, including China, which recently introduced the digital yuan. This innovation is not just a technological advancement but a paradigm shift in the world of finance, with implications on privacy, freedom, and the overall economic structure. Global landscape. China has pioneered the digital currency space, introducing a currency that exists solely in cyberspace. This has spurred other major nations to explore the possibility of launching their own digital currencies. The U.S. is also exploring this avenue, with President Biden issuing an executive order to investigate the feasibility of a U.S. central bank digital currency. This exploration is driven by the realization that digital currencies could potentially replace the U.S. dollar, impacting the global economy significantly. Trust and government control. Historically, trust in government to act in the best interest of the citizens has been waning, with only 1 in 5 Americans currently trusting the government. This skepticism extends to the adoption of CBDCs, as they would give governments unprecedented control over currency, raising concerns over privacy and freedom. The government's ability to monitor and control transactions and potentially freeze assets raises questions about the balance of power and the potential for abuse. Implementation and functionality. The new payment system, while complex, promises instantaneous transactions, allowing businesses and individuals to send and receive payments in real time, 24/7. This system would modernize banking, potentially lower banking costs, and expedite government stimulus disbursements. However, the potential downsides include surveillance and behavioral control, leading to apprehensions about the concept of CBDCs being a tool for Big Brother control. Historical context and power abuse. Historical instances, such as the 1933 decree by Franklin Roosevelt requiring citizens to relinquish their gold, illustrate the potential for government overreach and abuse of power. The IRS's targeting of conservatives between 2010 and 2012 for tax evasion is another example of power abuse, emphasizing the need for caution and scrutiny in the implementation of CBDCs. Conclusion and personal opinion. CBDCs are not necessarily a threat to cryptocurrencies or a tool against consumers. They are more about global commerce and maintaining the U.S.'s competitive edge on the global stage. The innovation aims to combine government trust and private sector innovation to create a revolutionary financial product. Despite the potential benefits, the inherent risks and the inevitability of CBDCs necessitate a balanced and cautious approach. While the adoption of CBDCs seems inevitable as countries strive to stay competitive, it's crucial to weigh the benefits against the potential risks and implications on freedom, privacy, and government control. Central bank digital currencies, CBDCs, and cryptocurrencies like Bitcoin operate on fundamentally different principles but could potentially coexist and interact in the financial ecosystem. CBDCs, being state-sanctioned, are centralized and regulated forms of digital or virtual currencies, designed to streamline payments, reduce costs, and enhance financial inclusion. Bitcoin, on the other hand, is decentralized and operates on a peer-to-peer network, emphasizing user privacy and financial autonomy away from governmental oversight. The interaction between CBDCs and Bitcoin could manifest in various ways. For instance, central banks might develop platforms or systems to facilitate the exchange between CBDCs and cryptocurrencies, enabling users to transact or convert currencies seamlessly. However, the decentralized and unregulated nature of Bitcoin may pose challenges and concerns for central banks, particularly regarding anti-money laundering, AML, and combating the financing of terrorism, CFT. The coexistence of CBDCs and Bitcoin could potentially lead to a more diversified and resilient financial ecosystem, but it also necessitates robust regulatory frameworks to mitigate risks and ensure financial stability. See you in the next video.